Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Ouster.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into the details today, here is a really useful chart tool for investors and traders.
Yeah, if you want help reading trading charts more clearly, you can check out VIP Algos through the link below in the description.
Right. VIP Algos is a TradingView indicator suite. It basically shows visual buy and sell chart alerts, trend direction tools, support and resistance zones.
And, take profit and stop loss planning areas, which is super helpful.
Exactly. And it can be used across markets, so like stocks, forex, crypto, gold, indices, futures, all of that.
Just remember, though, VIP Algos is an educational chart analysis tool only. It is not financial advice, it does not place trades for you, and it doesn't guarantee profits.
Yeah, trading involves a lot of risk, so always manage your risk and do your own research.
And just a heads up, this is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
All right, let's move into the wealth building context because, today we are looking at a pretty glaring market paradox.
Oh, totally. We are tracking a company that just saw, over 40% of its stock value just completely vaporized in a matter of days.
Yeah, 40% wiped out. But then, on the flip side, Wall Street analysts are simultaneously projecting a massive 50% upside from its current trading levels.
Which is just wild to look at. So to figure out if Ouster's underlying tech can actually outrun the intense gravity of its own cash burn, we really need to parse through the recent analyst notes, their latest earnings disclosures, and all those filings detailing some pretty heavy insider selling.
Plus the broader macroeconomic data that's driving all this volatility right now. Because the tension here is palpable. It really stems from this massive collision between a structural, long-term technological revolution and, the immediate brutal mechanics of the stock market.
Right. And you really have to understand the specific space Ouster occupies to get why this is happening. We spend so much time on this show talking about generative AI.
The software, the language models, all the data processing.
Exactly. But the next frontier is physical AI. That is what happens when artificial intelligence is actually given a physical form.
Yeah, we're talking about autonomous industrial robotics, self-driving fleet vehicles, and some highly advanced defense systems.
But a brain, no matter how advanced the neural network is, it's functionally useless in the physical world without an optic nerve.
Right. It has to physically see its environment to interact with it.
And that is exactly what Ouster is building. They design and manufacture digital LiDAR sensors. They're essentially building that optic nerve.
And right now, they are navigating a total supercycle of demand for this specific hardware. The wealth-building context here is crucial because, let's be clear, this is emphatically not a defensive safe haven.
Definitely not a steady dividend play.
Not at all. This is a highly speculative, high-growth thesis for a portfolio. You're basically making a structural bet on the rapid acceleration of autonomous systems infiltrating global supply chains and military infrastructure.
It's really tempting to look at this through that old picks and shovels framework, like selling the tools during a gold rush. But I actually think that analogy undersells the integration here.
How so?
Well, a miner can buy a shovel from literally anyone. But Ouster is trying to build a central nervous system architecture for all these machines. If you try to guess which specific drone manufacturer or which warehouse robotics company is going to win the global market share, you're essentially throwing darts blindfolded.
Right. It's a total guessing game.
But if you invest in the foundational sensor technology that the entire industry requires just to function, you are basically indexing the entire movement.
Yeah, that makes sense. That structural positioning is exactly why institutional interest remains so resilient here, even through all this intense volatility.
Yeah.
You are betting on the mandatory infrastructure of autonomy.
But we have to be incredibly clear with everyone listening. This requires a very specific risk appetite. Oh, absolutely. This is a catalyst-driven growth story for someone who can actually stomach severe quarter-to-quarter price swings and maintain a multi-year time horizon.
Yeah. That gives us the bigger picture. Now let's look at the fundamentals, because we need to ground this high-flying narrative in the actual financial reality. And honestly, the top-line metrics they're reporting right now are almost aggressively bullish.
They really are. We are looking at trailing 12-month revenue growth, sitting at 57.34% year over year.
Wait, 57%?
Yeah, nearly 60% growth at this stage of their scaling, which is a massive signal of broad demand. They aren't just selling to one niche sector. This revenue is pulling from industrial automation, automotive integration, and defense.
Wow.
But the metric that truly separates them from legacy hardware manufacturers is their gross margin. It is hovering at an incredibly healthy 48.99%.
A near 49% gross margin on a physical piece of hardware. That is practically software territory.
Right.
That tells me they have some serious pricing power in the market right now. They do, and that pricing power is directly tied to the underlying engineering of their product. Ouster basically created a massive competitive moat by shifting the whole industry from mechanical LiDAR to digital solid-state LiDAR.
Okay, break that down for us. What's the difference?
Well, for the last decade, the industry standard was this bulky sensor unit with physically spinning lasers and mirrors inside.
And anyone who has spent even 5 minutes in hardware engineering knows that moving parts are the ultimate enemy of longevity.
Exactly. A spinning laser inside a mechanical housing means friction, it means wear and tear, constant recalibration.
And inevitable failure, right? Especially if you put it on like a drone pulling heavy G-forces or a truck driving over unpaved industrial roads.
Totally. The mean time between failures from mechanical LiDAR was just a massive bottleneck for scaling autonomy. So Ouster digitized that entire process. They engineered a way to put the lasers and the receiver arrays directly onto semiconductor chips.
Oh, wow. So it's a completely solid-state device.
Yep, no spinning mirrors, no internal moving parts at all.
The implications of that have to be massive.
They are. It drastically lowers the unit cost to manufacture at scale, the durability is exponentially higher, and the form factor is just vastly smaller.
Which creates a remarkably sticky ecosystem. Like, if an original equipment manufacturer designs the physical housing of their autonomous drone around Ouster's specific microchip dimensions.
Right, and they write their point cloud rendering software to integrate seamlessly with Ouster's API.
They can't just rip that out in 2 years. The switching costs to pivot to a competitor's hardware later would require a total ground-up redesign of their own product.
Exactly. The architecture locks the customer in. Once you are designed into the physical and digital footprint of an autonomous vehicle, your recurring revenue from that client is highly insulated.
I mean, I understand the top-line beauty of that, but I have to put my analytical hat on for a second and look at the bottom-line nightmare here.
Oh boy.
Because they are generating incredible growth, sure, but the EPS is a staggering negative 0.9698. The net margin is an alarming negative 30.12%.
Yeah, it's rough.
They are bleeding 30 cents on every single dollar they make just to fund this expansion.
The cash burn is definitely the elephant in the room. And, to be fair, management knows exactly how fragile a hardware company is when it relies on external capital to scale. Which brings us to July 2, 2026.
The public offering.
Right. Ouster executed a massive public offering. They priced over 3.6 million new shares at $55.22. And they pulled in roughly $191.9 million in net proceeds.
Which violently dilutes the existing shareholder base. I mean, that hurts.
It was a brutal short-term hit, for sure.
Yeah.
But if you look at the balance sheet context, that capital injection boosted their pro forma cash position to approximately $375 million.
See, $375 million sounds like a great war chest until you factor in that negative 30% margin. How many quarters does that cash actually buy them if the macro environment tightens up and these big contracts stall out?
Well, the modeling suggests it gives them a secure multi-year runway. And honestly, that is the trade-off management forced upon the shareholders. They traded short-term equity value to guarantee their long-term survival.
Okay, so with $375 million, they can aggressively fund their R&D.
Exactly. They can continue pushing the solid-state chips to a smaller, cheaper scale and capture early market share without the existential threat of just running out of money.
Or facing bankruptcy, or an even worse emergency dilution down the road when the stock is lower.
Right. That gives us the business picture. Now let's move to the catalyst timeline. Because they bought time, but the question now is, what exactly is the market expecting them to buy with that time?
With that cash secured, all eyes are shifting to the Q2 2026 earnings expected this August.
The August earnings call is absolutely the immediate proving ground. Investors already know the balance sheet is fortified now. What they demand to see is how management quantifies that newly funded physical AI backlog.
Yeah, we need granular metrics. We need to see that this $200 million capital raise is directly translating into tangible, booked, and binding orders from major clients.
And beyond just the corporate backlog, the macro catalysts operating in the background are massive, particularly regarding global defense spending.
Yeah, the geopolitical landscape right now is, unfortunately, acting as a major accelerant for autonomous technology.
We are seeing an unprecedented shift in modern warfare tactics. They're real-world deployments in active conflict zones.
Like the autonomous interceptor drones in Ukraine.
Exactly.
Yeah.
Ukraine, the unmanned patrol vessels in the Strait of Hormuz. These deployments are rewriting military procurement budgets globally.
And if you are deploying a kinetic interceptor drone, one that's designed to track and physically collide with an incoming enemy drone at like 200 miles per hour, standard cameras and GPS are completely insufficient.
Not going to cut it.
You need hyper-fast, high-fidelity spatial mapping in real time. You need solid-state digital LiDAR that won't just shatter under the G-force of those maneuvers.
The military utility of Ouster's tech is undeniable. And alongside defense spending, we also have to look at the macroeconomic environment, because the market is currently pricing in potential interest rate cuts by the Federal Reserve in the back half of 2026.
And the math here is incredibly important for pre-profit tech stocks, right?
Massively.
When you value a company like Ouster that isn't expected to generate true bottom-line profit for several years, you use a discounted cash flow model. You basically take all the earnings they might make in 2028 or 2030 and discount them back to today's value.
And the discount rate used in that formula is heavily influenced by the baseline interest rates.
Right. So when the Fed holds rates high, the discount rate is brutal. Future dollars are worth significantly less today because, well, you could just park your capital in a 5% treasury bond right now with zero risk.
But if the Fed cuts rates, that discount rate shrinks, which mathematically inflates the present value of Ouster's future expected earnings almost overnight.
Yeah, a rate cut cycle acts as a massive valuation multiplier for these high-growth pre-profit companies. It fundamentally shifts the cost of capital in their favor.
But let me push back on this reliance on the catalyst timeline for a second. The Fed is notorious for telegraphing rate cuts and then just delaying them if inflation data comes in even slightly hot.
It's true.
And more importantly, government defense contracts are legendary for their glacial pacing. The bureaucracy required to get a new technology vetted, approved, and integrated into the Department of Defense budget takes years. Are we just banking on unconfirmed rumors to hold up this stock price?
The skepticism is completely warranted. Defense contracts are a very slow burn. The rumor mill might chatter about massive autonomous drone fleets being ordered tomorrow, but actual procurement and revenue recognition takes a long, long time.
So what's the actual catalyst then?
The true catalyst isn't necessarily a surprise DoD contract announcement next week. It's the structural, systemic shift in defense budgets, prioritizing sensor technology over the next 3 to 5 years. The August earnings call will be our primary gauge to see if those long-term discussions are finally converting into short-term cash flow.
Okay, that makes sense. Catalysts tell us what could change the story. Now let's pivot to the chart. Because the narrative and the fundamentals only matter when we see how the market is actively pricing them.
And the recent chart action has been incredibly violent. We are looking at the stock trading around $37.04 today, but the real story is the drawdown. It pulled back an aggressive 41.9% from its 52-week high of $63.79.
That 41% haircut is just the direct mathematical result of the public offering. When you price 3.6 million new shares at $55.22, you dramatically increase the supply of shares in the open market.
Right, so the price just has to contract heavily to find a new equilibrium based on all that diluted equity.
But what really fascinates me is the underlying momentum beneath that drop. Because even after losing almost half its peak value, the stock is still up over 71% year to date.
That's crazy.
I know. The 13-week return is over 51%. The macro trend remains undeniably bullish. The market took the dilution on the chin and held its ground.
And if you look at the volume, it tells a pretty compelling story, too. Volume is currently running at 1.15 times the 3-month average.
So the market isn't just passively watching the stock drift lower on low interest.
No, not at all. The elevated volume indicates active absorption. Institutional and retail buyers are stepping in at these compressed levels to accumulate the newly issued shares. The demand to own this equity is basically matching the new supply being dumped onto the market.
We also have to address the stock's beta, which is currently sitting at 3.33.
Oh, wow.
Yeah. For context, the broader market index has a beta of 1. With the beta of 3.3, Ouster isn't just riding the market's waves, it is strapped to the nose of the rocket.
The volatility here is weaponized. Like a 1% dip in the broader market feels like a 3% of 4% free fall for Ouster, and vice versa on the upside.
Which is exactly why mapping the technical structure is not optional for a stock like this. The price action is currently finding critical support near the $33.88 daily low. When you are dealing with a beta over 3, you need highly defined risk parameters.
You absolutely cannot trade a stock this volatile on gut feeling alone. Knowing precisely where the historical support and resistance zones sit is how you survive the chop.
Right, which is exactly why visual tools like VIP algos are heavily utilized by traders looking to map out those exact risk thresholds on these high beta charts. The structure grounds the volatility.
So the chart gives us price structure, but what does market sentiment look like? Seeing how Wall Street is reacting to this massive dilution is actually quite revealing.
Wall Street seems entirely unfazed by the short-term pain, honestly. We're looking at notes from Oppenheimer analyst Colin Rush, who recently maintained an outperform rating and aggressively raised his price target to $57.
From the current $37 level, a $57 target represents a more than 50% upside. The institutional consensus appears to view the capital raise not as a sign of distress, but as a necessary strategic arming process.
Yeah, they see Ouster building the balance sheet required to actually capture the physical AI market share that is rapidly expanding.
I do want to dig into the insider flow, though, because analyst targets are one thing, but executive actions are another.
Oh yeah, the SEC filings.
Right. Over the last 90 days, insiders have sold a net of roughly 895,000 shares. On paper, almost 1 million shares being dumped by the people running the company looks like a massive red flag.
It certainly looks alarming until you apply the insider market sentiment prediction ratio, or MSPR. Currently, the MSPR for Ouster is sitting at a perfect 100.
Wait, how does the sentiment model output a perfect 100 if the executives are actively selling off 1 million shares?
Because the model parses the mechanics of why those shares are being sold. When you analyze the individual Form 4 filings, you see a really distinct pattern. These executives are exercising long-held stock options after a massive year-to-date run.
Okay.
So let's say an executive exercises a grant at $10 a share, and the stock is currently trading at $40. They instantly owe ordinary income tax on that massive spread.
Ah, I see. So the selling is a structural tax event. They're basically forced to liquidate a portion of the newly acquired shares simply to cover the IRS bill generated by the exercise.
Exactly. They are selling to cover taxes or taking a mandated percentage of profit off the top, but they're retaining the vast majority of their core underlying positions. An MSPR of a 100 indicates that the internal data views this activity as a signal of strong, long-term confidence from the C-suite, despite the superficial appearance of net outflows.
That's a really vital distinction, but let me ask the cynical question here. Is the broader market just suffering from AI fatigue? Like, are analysts so mesmerized by the shiny physical AI buzzword that they are willingly ignoring the underlying financial strain?
That sentiment picture is useful, but we still need to talk about the risks. A 50% upside target is fantastic, but the bear case here is incredibly sharp. The risks are material and they cannot be ignored.
What's the primary anchor holding this stock down?
The permanent reality of the dilution. Securing $200 million is great for survival, but that newly inflated share count never goes away. It permanently suppresses the EPS metrics.
Right, because even in a scenario where Ouster achieves massive profitability in 3 years, that profit pie is now sliced into millions of extra pieces, which mathematically caps the upside valuation of individual shares.
Furthermore, their entire profitability timeline is remarkably fragile. We are leaning heavily on the assumption that they maintain that beautiful 49% gross margin. But that $375 million cash runway evaporates rapidly if the macro environment shifts.
Yeah, the competitive landscape in LiDAR is fierce. If a well-funded competitor suddenly achieves a breakthrough in their own solid-state manufacturing and forces a brutal price war, Ouster will have to compress those margins to maintain market share.
And if the margins shrink and the cash burn accelerates, that multi-year runway could shrink to 18 months, forcing them right back into the capital markets for another round of dilution. And the market is rarely forgiving the second time around.
We also have to respect the macroeconomic reality. We outlined rate cuts as a massive bullish catalyst for their valuation earlier, but inflation has proven incredibly sticky. If the Fed looks at the data and decides to hold rates higher for longer through the end of 2026, the cost of capital remains punishingly high. The broader market environment will actively work against high-beta, pre-profit companies like Ouster, entirely independent of how good their digital LiDAR tech actually is.
You are balancing a pristine, visionary technological narrative against a very harsh set of financial realities.
So with everything on the table, what's the final verdict? Synthesizing the $375 million balance sheet, the solid-state technological moat, the macro headwinds, and the extreme chart volatility.
Based on all the aggregated data, Ouster receives a bullish score of 8 out of 10.
An 8 out of 10, okay.
Yeah, the foundational thesis is that Ouster is positioning itself at the absolute epicenter of a permanent structural shift in global supply chains, industrial automation, and drone defense.
Even with the dilution.
Right. The recent capital raise inflicted undeniable pain on short-term holders, resulting in that 41% drawdown. However, mathematically, that same pullback has generated a high-conviction entry point for investors who fundamentally believe in the long-term technology cycle.
With Oppenheimer's 50% upside target providing some pretty heavy institutional cover for that exact thesis.
Exactly. The strategy here points to a multi-year hold phase. It is an accumulation setup specifically designed for an investor capable of absorbing extreme beta volatility, trusting that management will efficiently deploy that $375 million war chest to dominate the physical AI hardware market over the next 12 to 24 months.
It definitely requires high risk tolerance, lots of patience, and a really clear understanding of the macro forces at play.
Absolutely. And to be perfectly clear, this analysis is for educational purposes. It is not financial advice. We are not telling you to buy, sell, or hold any security, and you must always do your own research before making investment decisions.
And if you want a cleaner, more structured way to read the extreme volatility on trading charts, you can check out VIP Algos through the link below in the description.
VIP Algos is a TradingView indicator suite featuring visual buy and sell chart alerts, trend direction tools, support and resistance zones, and take profit and stop loss planning areas.
Again, it is an educational chart analysis tool only. It is not financial advice, it does not place trades for you, and it doesn't guarantee results. Trading involves risk, so always do your own research and manage your risk.
And this is an affiliate link, so we may earn a commission at no extra cost to you. And if our analysis today helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua.
Next time you see a video of an autonomous drone navigating a dense forest at high speed or a robotic arm sorting packages on a factory floor, don't just marvel at the machine itself. Ask yourself who built the optic nerve that allows it to perceive the physical world. That invisible foundational infrastructure is often where the most dramatic shifts in wealth truly begin. Until next time.